This is PropertyBT, a podcast of BT correspondents.
Singaporeans like real estate. We are land scarce. Many people have much of their wealth tied to real estate. We hear stories of great returns being made from owning real estate here. But property prices today are high. Is buying Singapore property today a sure bet? Should investing in Singapore property be best done directly, or are indirect options such as shares in listed property developers and units in listed real estate investment trusts or REITs worth considering? Today, the global backdrop is chaotic. There are geopolitical uncertainties, the actions of US President Donald Trump, global warming, the rise of artificial intelligence, and so forth. Welcome to PropertyBT. I'm your host, Leslie Yee, senior correspondent of the Business Times. I need a guru to guide us on how to invest our hard-earned money. Warmest welcome, Gabriel Yap, Executive Chairman, GCP Global.
Thank you, Leslie, for having me.
Gabriel, many property asset types in Singapore have performed well in recent years. Amid chaos, people may seek safe haven assets which we can touch and feel. Add to that low interest rates, and there could be positive tailwinds for physical property assets in Singapore. But are prices already too high? Maybe the risk-reward of buying physical property in Singapore at today's prices does not make sense. Gabriel, what is your take on physical real estate in Singapore? Where are the opportunities today?
One has to approach it from two ways. One, if you're buying a home, then of course, price is less of a concern. And the outlook in the future is less of a concern. But if you're looking for an investment perspective, then I totally agree with you, Leslie, that the prices have surged substantially, not in just the last 10 years, particularly so in the last 20 years. If you look at landed property prices in Singapore, especially the key regions that have a lot of relatively higher transactions like District 19, District 15, District 14, District 13, in just the last 3 years, prices have actually gone up close to 100%, particularly after COVID. So if you use 2020 as a comparison in 2026 first quarter, you're getting 100% gain, particularly so if you look at the property type, detached, semi-Ds, as well as terrace houses. Now, from a condominium perspective, new launches, particularly the ones in Lentor, downtown, for example, Newport Residences, they achieve an average price of $3,370 per square foot. This is not even in town, as in basically in prime Orchard Road. I remember when I first bought my first property in Orchard, that's Richmond Towers, 20 years ago, $600 per square foot. That time, the developer was DBS Land. Non-prime versus prime, prices has gone up from $600 per square foot to $3,370 per square foot over a period of almost 20 years. Where is the upside further? A little bit difficult to project, maybe say $4,000 per square foot. Prices for prime properties in Singapore, like the parts of Orchard Road, if you're using condominium as a comparison, compared to the major cities like New York City, London, yes, there will be further upside. If you look at this structural flows that's coming through, the multi-networkings that we actually have with many of ultra-rich individuals, the new immigrants coming to Singapore, price is less as a matter of for them. What they want actually is to find a home. It's more on a location where the property feels like a home for them, and bigger places where their own home sizes back in India or back in China was actually much bigger. So they find that Singapore, while it's smaller, it's probably cozier. So yes, prices are higher, but they can still afford because one, they tend to be higher cash rich. Two, interest rates are likely to continue to go down. So I would actually characterize it as a dichotomy, whether you're looking for a home to stay or a place to invest.
From an investment perspective, does it make sense to invest in property simply because the mortgage rates are low and therefore you can use leverage to enhance your returns?
From my personal perspective, because I own a couple of investment properties, property tax have actually gone up. Rental income has been going up in the last 2.5 years. A little lack of supply during the period just after COVID. But now we are seeing a supply coming from both the private developers as well as government projects. In fact, government projects are going to hit historical high over a blended 5-year period beginning from 2026 right up to 2028, with new places like Tengah, Bidiri opening up new launches. So that's supposed to actually ease off the supply. But what I'm seeing from the rental market is that when my tenants renew, we are still getting better rentals simply because of the ABSD rule. A lot of people will find it very difficult buying second property, paying ABSD as much as 60% if you're a foreigner. A Singaporean, if you're owning your second, third, or fourth property, ADSB is high. But net this off, and if you're willing to hold your property for, say, 10, 20 years, assuming that interest rates stay low at the current level, you get a rental yield of 4.5%, 5% for older developments, say 10 to 15 years. If your mortgage rates, if you get on a long blended basis, it's about 2.25% currently. Rentals are still going up because we're still seeing a lot of foreigners coming to Singapore. Singapore now has been promoted more like a fun city. You are actually seeing more people coming in, not just only on education, which was the case for their kids, say 10, 20 years ago. Right now, you're seeing people coming in because of jobs opportunities. Singapore promoting new sectors like stem cell technology, artificial intelligence. So you're getting new skills, and these people temporarily, before they become Singapore citizens, if they so decide, are still looking for short-term housing, rentals in private condominiums. And these are fairly good paying jobs. And that, I think, exemplifies what's going on in the private market, particularly so for rental condominiums. So from an investment class perspective, that's where the market's settling at this juncture and likely to continue for the next 2 years.
Gabriel, Singapore stocks have started to rally, and the shares of Singapore listed property development and investment companies have also done well over recent months. Yet many listed property companies still trade at discounts to net asset value or book value. Is there a compelling case to invest in listed property companies? Moreover, these companies may receive a profit boost when financing costs are lower due to low interest rates. Do you see shares of listed property development and investment companies as good investments today?
Not as good as what they used to be, say, 5 to 10 years ago. Because the model, not only just in Singapore, but across the world, particularly the developed countries like the US, UK, the key markets in Europe, for example, like Berlin, you will see that property development companies are no longer trading at huge premium. In fact, most of them are trading at sharp discounts to NAV. Not only just this year, last year, but we've been looking at it since COVID. And the disheartening thing is that this discount has widened further. So if anything, the market is telling us that it's no longer pricing a premium for such property developers. The market's looking at property developers lightening up their balance sheet. Hence the many endeavors and efforts that's been done by the CapitaLand Group, Capital Corporation, even though they are not directly into property development. I think many of them will see it as a extension of the property development projects, particularly say in retail, office, or residential. Then they need to develop a real estate investment trust arm so that they can own it, derive management fee, and then list it separately. So this is exactly close to what Hong Kong Land has done when they established the 8.2 billion office fund, even though it's a private fund. Definitely, you get a better uplift in terms of the discount to NAV on Hong Kong Land after doing this compared to holding the same properties under Hong Kong Land as a holding company. And that's where you see that discount widening in the last 25 years that Hong Kong Land has listed in Singapore. So if you're asking me if the discount on property developers, will it continue to persist? The answer is definitely yes. Is it a good time to buy and take an opportunistic view on this discount narrowing? I think there are better opportunities looking at structural trends that's happening across the world. Because when we talk to a lot of institutional investors, family offices, balance sheet across the world, for many of the top-notch companies like your Amazon, your tech companies like Google, Alphabet, Meta, companies that yield much higher operating cash flows, which then goes on to be able to pay capex as well as shareholders' return via dividends and deriving free cash flows. other kind of companies that would deserve premium in the market these days. Hence, you can see the premium attached, the magnificent 7 stocks in the US, top 10 stocks trading in Europe, while the ones with the higher free cash flows going forward are the ones that are getting premiums. Whereas the property developers from the likes of your Stockland in Australia to the big developers like British Land in the UK to some of the Singapore names like City Development are seeing the discount to NAV widening. So it's a development which I think is happening globally, which I don't think will reverse in a very short term.
In the Singapore property universe, there's also Capital Land Investment or CLI. So CLI offers a somewhat different investment proposition. It is basically a big real estate fund manager. Gabriel, how should investors view CLI versus other listed property companies here?
I think CLI should be evaluated similarly to most companies. Top line growth, that's revenue. We look at bottom line growth, that is net profit growing. But more importantly, when companies like CLI report their operating cash flow, we want a higher element of that operating cash flow as free cash flow, meaning that there would be more than sufficient of the operating cash flow which is derived from their normal operations that will be returned to shareholders, either via dividend or share buyback. And that's basically where many of the premiums should be attached. So if CLI is showing a higher inclination to do that, corporate structure to move towards direction, people will then play a slight premium on that. If you just look at the last 2 years' performance on Capital Corp, when they try to streamline their heavy capital balance sheet towards a freer cash flows by distributing their in-species stocks, for example, like Capital REIT, you see the free cash flow as a percentage of operating cash flow moving up. And that's why you see the share price move like 30% in the last 2 years, despite rather lackadaisical market in Singapore for Singapore stocks other than real estate investment trusts and other than the banks.
Still to come, choosing among physical property, property developer stocks, and REITs. That's after the break.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to PropertyBT, a podcast of BT correspondents.
Welcome back. Gabriel, in the local market, you are well known as an authority on REITs. REITs are interest rate sensitive. In a low interest rate environment, investors may flock to REITs for the higher yield. Also, the trust will be able to distribute more to unit holders when their interest expenses are lower. What is your outlook for Singapore-listed REITs over the next 6 to 12 months?
I have definitely turned positive since last year. One of the key things is that REITs trades inversely with interest rates movement. REIT market in Singapore since 2002. We're looking at 23 years of history since the first listing of Capital Land Mall Trust, now known as Capital Land Integrated Commercial Trust, as well as Ascendas REIT, now known as Capital Land Ascendas REIT. You can see that essentially after 3 interest rate upcycle, 2004, 2006, and then during the 2017 period, and now the up move from 2022 to 2024. You are seeing now the third possible rally in the Singapore REIT market. The last time when the REIT market rallied substantially, it was really with speed and with power. In the last rate upcycle, when the Federal Reserve stopped increasing interest rates 2018, the Singapore REIT market rallied from 20th December 2018 all the way for 14 months with vengeance right up to 19th of February 2020. The REIT index at that time almost went up 67%. Is there a possibility that this kind of macro setting the stage for REIT to stage a multi-month, multi-year rally? I think the answer is yes. provided the interest rates continue to decline because of the appointment of the new federal chair. So his take on the monetary policy is a bit different from the current existing Federal Reserve chair, that's Jerome Powell. So his take is that monetary policies can actually help to decrease the US Federal Reserve. Through the Clarity Act, Scott Benson, the Secretary of State, is trying to use this tool to help to bring down the percentage of US deficit versus its US budget. So they reckon that it does not necessarily mean that a direct decrease of US interest rates will then straight away. But if you have a mix of quantitative buying tapering off to coincide with suitable stimulative fiscal policies, that's enough to bring down interest rates overall, as opposed to just increasing interest rates based on the current dynamics, that is labor market conditions, new jobs creations. So the way he approaches monetary policies and therefore interest rates becomes more embedded as opposed to the current reading by the Federal Reserve as I see it. Interest rates dependent directly on labor market conditions, job conditions, and then they respond quickly. If interest rates continue to go down and go down on a sustainable basis, then it goes back to your original question, Leslie, that whether real estate investment trusts able to latch on this, the answer is yes. And you're seeing initial signs of heating up. Since the early part of last year, M&A in Singapore among real estate investment trusts inching towards the 6 billion mark, with the latest big acquisition of CapitaLand integrated commercial of a major shopping center in Singapore. They undergoing not a brown project, but a green project in Hougang, which actually constrain their balance sheet, but they are still undertaking this. Capital REIT acquisition of one-third portion of MBFC, and I do see major M&A driving organic growth again, finally, after 6 years, that will permeate into the real estate investment trust profitability and therefore down to the DPU that they pay to investors. If S-Reits show the behavior of rising DPU to shareholders, that's where they become more loved. The discount to the NAV becomes lesser. In fact, many of them will then turn to premium to discount. And that's a phenomena I do see happening in the next 6 to 12 months.
Gabriel, so a generally positive take on REITs. In the REIT universe, should an investor choose the market leaders like CapitaLand Integrated Commercial Trust and CapitaLand Ascendus REIT, or should they opt for smaller REITs which may offer higher yield?
I think the first layer of rally among Singapore REITs would be the bigger ones. CapitaLand Integrated Commercial has shot up substantially. So today, they're pushing at 250. So for a mega REIT like this, surging close to almost 20% in less than 3 months, it's a major sit-up. So the likes of CapitaLand, Ascendus, Fraser Centrepoint Trust, and possibly some of the Maple Threes coming through are likely to be the first layer of REITs driving rally. The second line that will come are the better positions, mid-size REITs that are doing the right things. That means positioning the assets such that you get positive DPU growth. These are the ones that will then lead the next rally. I'm only very skeptical to those down and out REITs, for example, those buffeted by commercial properties in the UK, buffeted by office properties in the US, where you see structural problems pertaining to oversupply in that sector. Don't think I will place a bet that this REITs will recover because of the various subsectors they are in this particular rally. So depending on which layer of the REIT, I think that's how I would play the REIT market going forward in the next 6 to 12 months.
The mantra is to start investing when young. Saving and investing matters, given the rising life expectancy. We may all lead long lives, and we need passive income to help fund retirement needs. Gabriel, how should a long-term investor think about physical property versus shares of property developers versus REITs?
Once you find a lovely home and pay down the financing as fast as possible, then one should be looking for using excess money for investments, buying shares, equity in growth companies, participating in syndicated deals on private companies that are likely to IPO, with huge premium pops are probably better ways of multiplying one's wealth as opposed to buying physical property for rental, which we saw in the last 20 years. One should be focusing on the capital returns kind of profits from sectors like in technology. The key thing now is artificial intelligence. We started the year with AI models from Claude, Entropy, disrupting certain sectors like legal, insurance, and software. So software in the US market took a dive of 26% in just 1 week in the US. So if anything, that is a good reason and a good benchmark of what it is to come for AI. Stock prices movement are always a harbinger of greater things to come, whether it's good or bad. And as a shrewd and sharp investor, one has to recognize this particular trend. Moving within AI, no longer playing the picks and shovels. So the likes, NVIDIA, AMD, Broadcom will broaden into what we call the application layer. These are the ones that uses AI to monetize their business models. Better investments than compared to, say, physical property investment, unlike 20 years ago. In the last 10 years, many of the private companies are no longer coming for IPO in a short period of time. When Facebook listed 20 years ago, from incubation to IPOs less than 5 years, now you actually have the likes of SpaceX, ChatGPT, which has been around close to a decade, not going for listing yet. That's the kind of premium that they're going to fetch. They're looking at 800 billion to a 1 trillion valuation. So that is the kind of things to come. So I would place my money on this kind or ride on this kind of development. Going forward, the usual among Singapore investors is to buy into income yielding instrument, be it real estate investment trust, buying physical property, buying a bond fund. It's giving way towards more capital-like returns, where returns can be phenomenal, risks are higher, but unfortunately, in an interest rate lower world, one has to take higher risks, and higher risk comes with higher bets, and higher bets come with higher returns.
Gabriel, I've enjoyed our conversation. Your knowledge and passion inspire.
Thank you so much, Leslie.
That's it for PropertyBT this week. Happy property hunting. Happy Chinese New Year. Next week, BT Correspondents will be back with an all-new episode on markets. So do subscribe to our channel and check it out. If you have any thoughts or questions about the show, email us at btpodcast@sph.com.sg. I'm Leslie Yee. As always, thank you for listening. See you next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.